Hello friends, good morning to all of you. And in the last video, we were learning about the taxation, which is the chapter number 25 from the module D. And we are now going to cover the second part of it. It's very much important. We have already learned about the old tax regime and the new tax regime. So do confirm the audibility quality at the earliest, first of all, so that we can proceed. So do confirm the audibility quality so that we can proceed. So this is a chapter number 25, module D. Okay, so let's audio video quality is working fine. So let's start the session. So it was about the first of all about the allowed deductions and the exemptions in the old regime and the new regime, right? So under the old regime, there were standard deductions allowed. Yes, those were allowed, right? And the same thing is allowed for the new regime also. But for the new regime, the standard deduction is allowed for salaried person, and that's allowed for up to 75,000 rupees, right? And section 80C deduction is not allowed in the new regime, like which was available for ELSS, LIC, EPF, etc. That's now not available. So under the old tax regime, there were many reductions which were allowed, whether it is related to the 80D medical insurance, home loan interest, HRA exemption, LTA, donation, NPS. Those were allowed, but not in the new tax regime. So 80D deduction that's related to the medical insurance, that's even not allowed in the new tax regime. The section 24B, home loan interest, let's say when it is self-occupied, that was basically up to rupees 2 lakh, that was allowed in the old tax regime but not in the new tax regime. HRA exemption is not allowed, LTA is not allowed, but 80CCD2 benefit is available. The benefit of 80CCD2, that's employer NPS contribution benefit, that is available, right? So that is one part which is available, right? And further, if we talk about the 80CCD1B, that's related to additional NPS amount. If you do basically do add to the NPS, that was allowed up to rupees 50,000. That is basically allowed in the case of the old tax regime, but not for the new tax regime. Even the section 80E, which is related to the education loan interest, that's not applied as a deduction. Section 80G, if you make any of the donations, that is also not allowed. Transport allowance for differently abled person, that is basically allowed. So mostly everything else is not allowed. Mostly everything else is not allowed. Only these much things are allowed, right? Getting it so far? Okay. And even if we talk about the gratuity exemption, that's allowed in both. The depreciation benefit is basically available in both. So that's about the old tax regime and the new tax regime deductions. So what is basically not allowed? If we look at the point that what is allowed and what is not allowed, so point is quite simple, that only for the few points, like standard deduction is allowed 75,000 rupees. First thing, the standard, I'm just highlighting those points which are allowed. The standard deduction is allowed. 80CCD employer contribution NPS is allowed. Transport allowed for differently abled person, and gratuity exemption, depreciation, like additional depreciation, that is allowed. That is allowed. Okay. And deductions which are not allowed, like 80C deduction, 80D, 24B for the home loan interest, HRA, house rent allowance, LTA, leave travel allowance, 80CCD, that is additional NPS, right? So these are basically not allowed. After that, it's about the Which tax regime is better? Option 1, it says example 1 for the salaried individual who is aged at 52. The point is, Mr. Anurag, 52 age, has a gross salary of 10 lakh. He has invested 1,70,000 under Section 80C, paid rupees 28,000 as a medical insurance premium, and paid rupees 75,000 as a home loan interest. Which regime saves more tax? Which regime will save more tax? Now, if we calculate as per the old tax regime, the gross salary is given to be what? It is 10,000 in both of the scenarios. The standard deduction of 75,000 allowed in both of the scenarios. And for the under 80C, the deduction for the old tax regime maximum was allowed for 1.5 lakh. It was limited to 1.5 lakh. Whether if you have the person has invested 1,70,000 under the 80C, it doesn't matter. The maximum limit is 1,50,000, and that's not applicable for the new tax regime. And 80D deductions were allowed for 25,000. That's not allowed in case of the new tax regime. And 24B, that's for the home loan interest. If it is self-occupied, 2 lakh is the maximum limit, and here it is given to be 75,000. So it is allowed in the case of old tax regime, but not for the new tax regime. So the net taxable salary is basically 6,75,000, and for the other scenario, for the new tax regime, only 75,000 deductions did work, and it is 9,25,000. So if we do compute the tax for up to 0 to 2.5 lakh, it is nil. And for the senior citizens, it is 0 to 3 lakhs, it is nil. So it is not senior citizen because he is aged at 52. So up to 2.5 lakh, it is nil. And up to 2.5 to 5 lakh, it is 12,500. And further, for 5 to 7.5, it is further what? It is 35,000. Now, previously, this particular tax regime was there, but now there have been some changes. I already told you. So we will be calculating it by that particular formula only. So we will be calculating as per the new tax regime only, right? So if we calculate it as a new tax regime, the tax slab is basically what? It is 5% slab. Do you remember that I told you about the tax regime slabs previously? So what were those slabs? Tax regime slabs. Very importantly, we have already discussed about that in the last one. We discussed about the surcharge, we discussed about everything, right? So if we look at the new tax regime, it is up to 3 lakh, there is nothing. And for the new tax regime, for 3 lakh to 7 lakh, it is 5%. For 3 lakh to 7 lakh, it is 5%. So we calculated as per that. 20,000. And 7 lakh to 10 lakh, but it is maximum 9.25 lakh. So we calculated at 5% for 3 to 7 lakhs, and for 7 to 9.25 lakhs, we calculated at 10%, it is 22,500, right? And for the old tax regime, for 2.5 lakh to 5 lakh, it is 12,500. For 5 lakh to 6.75 lakh, it is 35,000. And further, that's it. Because under the old tax regime, the net taxable salary is 6.75 lakh, right? So that's the point. So the income tax liability is 47,500 in the first case and 42,500 in the new tax regime. And the health and education cess is also available at 4%, which is over and above the income tax. Over this, the 4% is to be calculated. That is 900 for the first case and 1,700 for the second one. So the total tax payable, it is 49,400 for the first case and 44,200 for the second one. So under the new tax regime, only and only the standard deduction was available. But still, the new regime will save you 5,200 rupees. Okay. Now, let's have a look at the second scenario. High deductions which were available under the old tax regime. Miss Priya, age 35, gross salary 15 lakh, Section 80C 1,50,000, 80D 25,000, home loan interest 24B 2 lakh, HR exemption 1,20,000. So gross salary was, first of all, let's consider the old tax regime only. Gross salary is 75,000 minus deductions of 75,000, HRA exemption 1,25,000, 80C deductions 1,50,000, 80D deduction 25,000, home loan interest 2 lakh. So the net taxable salary became 9,30,000, right? And based upon that, we computed the income tax, and that came out to be 1,36,000. Now, how the 1,36,000 figure came? Basically, you should be also be having the idea related to it, that how we calculate it, even if it is not there, right? We are still to calculate. So we are to calculate the tax liability, and the same way we are to calculate the tax liability under the new regime. Only the standard deduction of 75,000 were allowed, nothing else, nothing else. And if we do calculate the particular taxable total tax, that was basically 1,77,500 for the new tax regime, and at cess is 7,100. Total tax payable is, there is a very huge difference, there is a huge difference, right? So it's basically under the old tax regime, Priya was saving 43,160 rupees. Getting the idea? So sometimes it is basically very much helpful, but sometimes it is not helpful at all. Sometimes it is not helpful, right? Getting it? Getting the idea? Okay. So under the new tax regime, only the standard deduction of 75,000 is allowed, right? And what other benefits were available? Like the, like I just told you, that what benefits were available. There was the benefit related to transport allowance for the differently able person, for the employer, NPS contribution that was available, gratuity benefit that is available. Only these things are available. Only these benefits are available. Else no benefit, else other benefit is available. Further after that, it's related to investment products for tax saving. It's about the investment products for tax saving. So section 80C is dealing with what? Section 80C is basically having the maximum combined deduction which was allowed under the old tax regime. It was allowed for 1,50,000 maximum deduction which was allowed. And there are the multiple instruments, like we have the PPF, Public Provident Fund, ELSS, right? Mutual fund, that's basically there. EPF is there, Employee Provident Fund is there, and tax saving FD, NSC, National Saving Certificates, life insurance premium, and even the Sukanya Samriddhi Yojana, Senior Citizen Saving Scheme, and PM VVY Pradhan, that is basically Vaya Vandana Yojana, right? That's pension scheme for the senior citizens. Those all the schemes are available. Those all the schemes are available for maximum deduction. Like if you're paying any premium, or if you're basically investing in that particular field, then it will be covered for the benefit of maximum 1,50,000 per year, per financial year, that will be available. So under the PPF, the maximum deduction is 1,50,000. The lock-in period is 15 years, and for the particularly the interest rate does changes from time to time. The government announces the interest rate, and further it is coming under the triple E category, that exempt category. That whatsoever you earn, whatsoever basically was there, everything is basically exempted from the tax. No tax will be involved. Like whatsoever the amount that you have invested into it, no tax will be there. Like even if you invest 1.5 lakh there, and you have basically made investment in others also, still the interest that will be earning upon the PPF, that won't be taxable. Okay. Further, it's the ELSS mutual fund. That's basically market linked. The lock-in period is 3 years here. The lock-in period is 3 years, and the LTCG, long-term capital gain, is taxable, which is if let's say if it is above 1.25 lakh, then it is taxable. Then it is taxable. Further, it's about the EPF, Employee Provident Fund. The lock-in period is till the retirement. The lock-in period is till the retirement, and 1.5 lakh is the limit, and the interest rate varies. And exempt is exempted. Like if you get the partial withdrawal after 5 years, then the exemption is basically there. Then the exemption is there. Otherwise, not. And then it's about the tax saving FD, the maximum amount which is covered under deduction for 1 year basis, that's 1,50,000, and the lock-in period is for 5 years. The interest rate is varying, and whatsoever the interest that will be earning, that is taxable. That is taxable. NSC maximum amount again 1,50,000. Lock-in period is 5 years. The rate of interest may be varying from time to time, and further, the interest is taxable. The interest is taxable. But if the interest amount is reinvested, then it will be qualifying for the ATC. If interest amount is reinvested for the NSC, National Savings Certificate, for the LICs, the maximum amount again 1,50,000, and the lock-in period is up to the policy tenure, and for the maturity is exempted under section 1010D. The maturity is exempted, like if the sum assured is greater than or equal to 10x the annual amount, right? If sum assured is greater than equal to 10x the annual amount, right? So then it will be deduction will be allowed to you. Okay, maturity exemption will be there. Further, under the Sukanya Samriddhi scheme, the lock-in period is either 21 years or up to the age, up to the marriage of the girl child, and the current earning upon it is 8.2%, and it is coming under the EE category for girl childs. And this scheme is available actually for the girl childs who are basically aged up to 10. And then it is a SCSS. Under the SCSS, the maximum amount basically which the person can be investing is rupees 30 lakh. It's basically what it is, a 30 lakh rupees that the one can be basically investing into this particular scheme. That is a senior for the senior citizens, right? And that scheme is basically for the senior citizens. That's what scheme, that is actually the Pradhan Mantri Vay Vandana Yojana. Okay, LIC pension scheme it is. LIC pension scheme it is. And further, the lock-in period is 5 years and interest is taxable. Like TDS will be deducted if the interest is greater than 50,000 is being earned in that scenario. Okay. Further, it's related to the PMVY. So first one, it's related to the SCSS, that is Senior Citizen Savings Scheme, and the other one it is a Pradhan Mantri Vay Vandana Yojana. That's basically LIC pension scheme for the senior citizens. And here the maximum amount is 15 lakh rupees, and pension income is basically taxable at the slab rate. So if you are basically earning the any kind of the let's say interest rate, interest over it, or you're getting it as an income, so that particular pension will be counted as your income. That particular pension, that will be counted as your income. Clear with it? Clear with this idea? Do confirm at the earliest. So what is basically taxable under it, or what is not taxable? Now after that, there are some key deductions which are beyond ATC, which are basically allowed, which are beyond ATC, other than the ATC. The first one, it's the 80D, that's the medical insurance premium. So for self or family, it is 25,000 rupees. For the senior citizen parents, it was allowed for up to 50,000 rupees, right? And if the person is self senior citizen also, then the maximum deduction 80D will be 50,000 for self and 50,000 for the senior citizen parents, right? And let's say if the particular amount is 50,000 for self, then it is definitely that much amount only. Otherwise, in general, we can say it is 25,000 for yourself, for the family, and 50,000 for the senior citizen parents. Okay, that was the benefit which is available. Further, ATCCD 1B, that is an additional NPS for the self contribution. Additional NPS, right? So private sector, it is the limit is 10% of the basic. For the private sector, 80 CCD, one we are basically, or two we are talking about. So self contribution to the NPS tier 1 account, that's basically NPS tier 1 account, and that was available only under the old tax regime, not for the new tax regime. Okay, then it is a 80 CCD2. Now when we're talking about the 80 CCD2, it is a employer contribution. 80 CCD1 is dealing with the additional self contribution, but the 80 CCD2 is dealing with the employer NPS contribution, and there is a limit that's basically limited to 10% of the basic or DA for the private sector, and for the central government employees it is 14% of the basic and DA. Okay, and it is basically available in both the tax regimes. It is available for the old plus new both, right? But 80 CCD1, if we are talking about 80 CCD1, that was basically available only for the old tax regime, and 80C, 80D, that's also available for the old tax regime only, not for the new one. 24B, again it was available for the old tax regime. Like if it is self-occupied, the maximum limit was 2 lakh rupees, which can be allowed as deduction under the old tax regime. And further, if the entire if basically the property is let out property, then there is no cap. The entire interest that will be charged on the home loan, that you can be getting the deduction upon, right? But the condition was like that the construction is to be completed within 5 years. Construction within 5 years to be done. That was the condition. Getting it? So after that, it's about the 80EEA. That is a home loan interest affordable housing. Home loan interest under the affordable housing. So it was 1,50,000. And further, that was over and above the 24B. Like for the 24B, you were allowed the interest deduction. But for 80EEA, it will be like 1,50,000 over and above the 24B. So the stamp value is basically stamp duty value of the property is basically lesser than or equal to 45 lakh, and the person is a first time buyer, and the loan was sanctioned between 2019 to March 2022, right? That was basically, then the benefit only was available under the 80EEA, and under the new tax regime this is not available. This is just for the old tax regime. This is for the old tax regime. And even if we talk about the 80E, even if we talk about the 80 education loan, like the entire interest was deductible, right? There was no upper limit related to it. If the loan is approved from the financial institution for the higher education purposes, so the reduction was there. So that was related to the 80E. Then 80G is related to donation, not available in the new tax regime, right? And further, if the donations are being made to the charitable institutions, so 50% or 100% donation amount, that will be basically whatsoever the qualifying part, that will be adjusted. That was being adjusted, right? And if we talk about the 80 TTA, 80 TTA is basically the interest that will be earned on the saving accounts for the senior citizens. And there the limit is given to be rupees 10,000 per annum. Rupees 10,000 per annum. That is basically the limit given for the interest that will be earned by the senior citizens on the saving accounts. These are very important points, right? So definitely we should not be letting, we should be having an idea for the 80 TTA. It is related to interest on saving account for the senior citizens, right? For the non-senior citizens. And further, if we are talking about the 80 TTB, that is basically for the senior citizens. So this one is for the non-senior citizens, and for the senior citizens, it is 80 TTB. Okay. And for that scenario, it was 50,000 rupees for the interest deduction up to rupees 50,000, right? And it covers the saving plus FD plus RD, everything interest. But for the 80 TTA, for the non-senior citizens, it is just covering the saving accounts of 10,000 rupees. Getting the idea? Then 80GG. 80GG is actually related to what? It is related to the rent paid. It is related to the rent paid and no HRA is being received. Rent paid, no HRA is being received. So least of rupees 5,000 per month or 25% of the total income. Whatsoever it will be allowed, it can be taken as a deduction. It can taken as deduction, but now under the new tax regime, it's not applicable. So if we consider the different points over here, which are other than the 80C, the 80D is basically for the medical insurance premium, right? Otherwise, it was allowed for 25,000. But if you are self-senior citizen, then it is 50,000 for you and 50,000 for your senior citizen parents. And 80CCD is basically additional NPS self-contribution, right? And further, it was allowed on the NPS tier 1 for the old tax regime only. And the 80CCD2, that's basically available for both, like for old tax regime as well as the new tax regime, it is available. And for the 24B is basically the home loan interest. If it is self-occupied, the maximum limit was 2 lakh rupees. And for that it is let out property, then it has no upper limit. And 80EEA is basically home loan interest for affordable housing purposes. Like if you have taken the home loan between April 19 to March 2022, and your stamp duty value is basically less than equal to 45 lakh and you're first time buyer, then it is 80EEA. and 80 is related to the education loan interest, right? Education loan interest. And 80G is related to donations to the charitable institutions, and 80TT is basically related to interest on saving accounts. Like for the non-senior citizens, maximum limit is 10,000 rupees, and for the senior citizens, maximum limit is 50,000 under 80TTB, including the interest from saving account, from FD account, from RD account. That's basically the total limit, right? And 80GG is basically rent paid but no HRA received. In that scenario, it is least of rupees 5,000 per month, or 25% of the total income, whatsoever it is. And for the rent paid, minus 10% the adjusted income it is. Okay. So that's the scenario. Clear with it? Clear it with so far? Do confirm. And after that, the next topic is also again very much important. It's very much important. It's about the capital gain tax. It's about the capital gain tax. So if I have understood the point so far, do confirm so that we can proceed further. There might be confusion related to the old tax regime and new tax regime, and I have like tried to explain each and every point here. But still, if you're having any doubts, you can let me know, right? Okay. Now it's about the capital gain tax. So capital gain tax is basically charged on profit which is earned from selling capital assets. So let's say if you're having the capital assets like property, like shares, mutual funds, gold, bonds, jewelry, whatsoever it is, right? So let's say I purchased it for rupees 10, right? And I purchased after a few years for it for rupees 90. Now my capital gain is what? Capital gain is 80 rupees. Even if I purchased a share for rupees 5 or 50 and I sold it for 500, right? Whatever the quantum is, like it will be the 450 is a capital gain that I'm having. Getting the point? So capital gain is basically the tax that will be charged upon this capital gain. So whatever the excess earning, the government is going to charge a capital gain tax over it. That is said to be, and it is of two type. Like it is for one term, it is STCG, that is short term capital gain, and the other one it is LTCG, long term capital gain, right? It can be LTCG or it can be STCG. STCG means the short term capital gain, and LTCG means the long term capital gain. And tax depends upon what? It depends upon the type of the asset. It depends upon the type of the asset. It depends upon the holding period, and further it also depends whether the gain is the long term or the short term. Okay. So first, let's understand the short-term and the long-term capital assets. We say to be the STCA and the LTCA, right? So one thing it's about for the listed equity shares, like for the equity shares or equity mutual funds, if the holding period is up to 12 months, if you're holding it for up to 12 months, I'm writing over here. So if you're holding up to 12 months, then we say it to be what? We say it to be the short-term capital asset. And if you are holding for greater than 12 months, then we say to be the long-term capital asset. Okay. And further, if it is like what the tax rate would be applicable for the STCG, the rate that would be applicable, that is 20%. As per the budget 2024, it is 20%, right? And further, if it is long-term capital gain, for the shares, listed equity shares, for equity mutual fund I'm talking about, right? So in that scenario, it is what? It is 20% for the LTCA, for the STCA. And for LTCA, it is 12.5%. LTCG is 12.5%. The tax that will be applicable. And for LTCG, there is deduction. For LTCG, deduction is basically 1.25 lakh per annum. The second scenario, the second scenario, like if it is debt mutual fund, if it is debt mutual fund, and if you have bought it after April 1, 2013, right? And if you are holding it for any of the period, debt mutual fund, there is not any LTCG. There is not any LTCG upon it. Getting it? Right? And further, there will be no LTCG upon it. And if we're talking about the immovable property, if we're talking about the immovable property, land, building, house, etc., if the holding period is for less than 12 months or up to 12 months, if it is like up to 24 months, not 12 months, it's 24 months, then it is basically set to the short term capital asset. And if it is greater than 24 months, then it is long-term capital asset. Then it is long-term capital asset. And what would be the STCG? What will be the STCG? It is slab rate, right? And in case of the immovable property, there is a catch. That's why it is important. Why? Let me tell you. Like if you're not taking the indexation benefit, then it is 12.5%. If no indexation benefit is to be taken, then it will be like 12.5%. Under the indexation, under the indexation benefit, we have to like consider the inflation also over the different years. Over the different years, the inflation benefit was also to be taken care of. But if you're not taking the indexation benefit, like if the property was purchased after 23rd of July 2024, the deadline is 23rd of July 2024. After that, if you're purchasing the property, then the indexation benefit is not available, right? And when it is not available, it is 12.5% flat, like whatsoever the gain is. And if you have purchased the property before the 23rd of July 2024, then it is like lower of 12.5% without indexation, lower of 12.5% without indexation, or 20% with indexation. Whatsoever the lower part of it, these two, 12.5 or 20%, that will be applicable. The lower would be applicable. Getting it? This is for the immovable property we are talking about. And for the short-term capital asset, we say to be for up to 24 months. Okay. And for gold, silver jewelry, again the time horizon is 24 months. Like if you're holding it up to 24 months, then it is STCG. If you're holding more than 24 months, then it is LTCG. And for LTCG, 12.5% slab rate would be applicable. And for STCG, it is slab rate would be applicable, right? For LTCG, 12.5% rate would be applicable. Clear with it? And then it is about the unlisted shares, foreign shares. Unlisted shares or foreign shares. Then also the same thing. Like if you're having the unlisted shares and foreign shares, then it is 24-month applicable. Like up to 24-month short-term capital asset, greater than 24 months long-term capital asset, and further for short-term it is slab rate, and for long-term it is 12.5% rate that will be applicable. And for listed bonds and debentures, it is 12 months. So kindly take a note of it. Whenever we are talking about the listed bonds or debentures, or we are talking about the equity shares or equity mutual funds, the time period is 12 months. Otherwise, for all, it is 24 months. Getting it? And further, for the listed bonds, the slab which is applicable for the LTCG, it is 10%. For LTCG, the 10% slab is applicable. And further, for the equity shares, what was the slab? It was 12.5%. That's the only difference between the same. But the holding period we are talking about, it is 12 months for listed bonds and debentures, and also for the equity shares and the mutual funds. For the mutual funds. For agricultural land, that's basically not considered to be a capital asset, and that is not taxable. That is not considered to be a capital asset at all, and that is basically not taxable. Clear with it? So that's the complete point related to it. Now, there was an actually update in 2024 that was basically for the immovable property that we have already discussed. Like for the immovable property that is acquired before 23rd July 2024, taxpayer can be choosing like either they will be taxable 12.5% without taxation indexation benefit, or 20% with indexation whatsoever is lower, that they can be choosing themselves. and the property is acquired after 23rd of July 2024, then 12% without indexation benefit that will be applicable. And the STCG, the short-term capital gain, for what part? For particularly for the equity short-term capital gain that was basically increased. Previously, it was like 10% and for the 15%, and it is was increased to 20%. The short-term capital gain, right? Now, let's have a look at the key terms in capital gain computations. Important terms. The first thing, it is a full value of consideration. It's about the full value of consideration. Now you can directly be asked the questions about it. They can be direct the questions about it. You should just be having the idea. So it is basically the full value of consideration is the sale value which is received by seller. The total sale value which is received by the seller. That is a full value of consideration. FVC. And the cost of acquisition, like the original purchase cost of at which the asset was acquired, right? The cost of improvement, COI, the cost of improvement, like money spent so as to improve the asset, so as for renovation, extension, etc. And the fourth one, it's about the indexed cost of acquisition, like which is basically used to adjust the inflation impact, used to adjust the inflation impact. And the indexation cost of acquisition is what? It is basically the cost of acquisition, and we have to multiply it with the like the CII for the year for the sale year, and for the CII for the base year, CII for the purchase year. So that's the formula, very much important. And like basically for for the financial year uh 2001 and 2, it is considered to be the base year is considered to be 100. Let's say you purchased before year 2000. In 1993 you purchased some property, so the CII will be counted as 100. And let's say you're going to sell it in 2025, then it is 363. The property, the capital cost of acquisition will be calculated based upon this fraction. Okay, and this is basically used only for the LTCG with indexation benefit, that basically does the adjustment for the inflation. This is quite important, and this based upon this even the question can be asked. Then it is a cost inflation index, as I just told you, the cost inflation index, CII we say it to be. Then further, it's about the capital gain formula. For the STCG, what is the formula? For STCG, the formula is like FVC, the fair value, and for the minus the transfer expenses, minus the cost of acquisition, which is indexed if your indexation is benefit is allowed. But for STCG, the indexation is never allowed. So that's why it is mentioned to be unindexed. Then it is COI, cost of improvement, right? So that would be related to it. So that would be the part related to it. So capital gain is equal to FVC minus transfer expenses minus COA minus COI. That would be the formula. And for the what would be the formula for LTCG? Let me write over here. The LTCG formula, which is not mentioned here. So it's a sale value. It's a sale amount minus whatsoever the transfer expenses were there. And for the minus the indexed cost of acquisition minus indexed cost of improvement. That is the formula, right? So let's have a look at the example now so that you can understand it well. So Mr. Sharma purchased a residential flat in financial year 2010-11 for 30 lakh rupees. He made improvements worth rupees 5 lakh rupees in year 15-16 and sold it in financial year 24-25 for 95 lakh rupees. So this was the point related to it. He purchased it for 30 lakh, made improvements 5 lakh, and sold it for 95 lakhs. So what particular tax would be applicable? First of all, it's like greater than 24 months. You're selling it after for 24 months, so the LTCG would be applicable. LTCG would be applicable. So we have to first of all calculate the sale value. We have to calculate the sale value. So let's say we are considering the sale value like we are considering the brokerage or the legal fees to be 1%, right? So 95,000 are your transfer expenses. So we are considering the sale value is 95 lakh, and for the transfer expenses are to be subtracted. So it will be 94 lakh and 5,000. 94 lakh and 5,000. That is a value we are considering, the sale value we are considering. Okay. And now we are to basically calculate the cost of acquisition, indexed cost of acquisition. So purchase year CII we are to be looking into, and for this purpose it is given here. We are assuming it, or it is given as per the particular year for 2010-11. It is 167, and for the CII for the year of sale it is 363. So what will be the indexed cost of acquisition? What will be the index cost of acquisition? It will be 363. It will be basically 30 lakh rupees, and further multiplied by 167 divided by 363. 167 divided by 363, and it came out to be 65 lakh 20,958 something, right? That value came. And now basically the year of improvement, that is also to be considered, and we just calculated the indexed cost of improvement also, that was 7 lakh 15,000 almost. So that is to be added up, the cost of improvement, the total indexed cost, that is to be added up. So it came out to be 72 lakh 35,000 and 525. So the long term capital gain would be what? That your cost of basic acquisition, or let's say the sale price, right? So that minus the acquisition cost, and the capital gain came out to be 21 lakh 69,475. So now the option A is basically like the LTCG would be 20% with indexation benefit. It is 20% of the same. Or it is like option B, like without indexation benefit, it's simply just looking at 95 lakh minus 30 lakh minus 5 lakh and 7 lakh 50,000 based on 12.5%. So there are two options, right? Definitely the user will be selecting this one, right? And then the 4% cess will be added over it, and the total tax liability is 4,51,251. So this is how it is worked out. This is how it is worked out. Now let's have a look at the capital gain exemptions. Capital gain exemptions. Now the first case. Now this topic is quite important about the exemptions. This is very much important actually. So the first thing, it's about the section 54. Like, and this is basically applicable when the residential house is sold, right? When the residential house is sold, and for the LTCG is applicable. Okay, so if you purchase a house 1 year before, or let's say 2 year after the sale, when the LTCG was applicable, or construct within a period of 3 years of sale, so it is 1, 2, 3. For section 54 exemption, it is 1, 2, 3. What is 1? 1 is like if you purchase house 1 year before, or within next 2 years you have to purchase a new built house, or let's say if you're going to construct a house within next 3 years, then the section 54 exemption can be taken. So whatsoever the amount that you have reinvested into the new house, that upon that the LTCG exemption would be available. But there is an important limit related to it. Like, two house benefit is available once in a lifetime if LTCG does not exceed rupees 2 crore. Like if LTCG is not exceeding, if LTCG is not exceeding rupees 2 crore, right? Then maximum two residential properties allowed once in a lifetime. That the benefit that you can take maximally 2 times for the under section 54. Then it is about the section 54F. and that will be available when any long-term capital asset, LTCA we are talking about. Any long-term capital asset, LTCA, but not the residential house, right? If you're selling that, any long-term asset is being sold except the residential house, then the benefit 54F it will be available. For the residential house, it is 54, but for other than residential house, it is 54F. And what is the condition? That the entire sale amount must be invested in a new house, not just the gain. You're just to basically invest the entire sale consideration in the new residential house, then the benefit would be available. Then the benefit would be available. Okay. And further, there is a condition also. Here is a condition. Here's a catch. The condition is that the taxpayer should not own more than one residential house on date of sale. So you cannot be having more than one residential house in your name. So if you're having that one house, so then it won't be allowed. So same criteria 1, 2, 3 for 54F even. 1, 2, 3. That purchase 1 year before, 2 years after, or construct within 3 years. Then 54 EC, that is also applicable to any of the long-term capital asset. Any long-term capital asset. So you have to invest the capital gain. So in 54F, we were talking about the complete amount. We were not talking about the capital gains only, but in case of 54 EC, we are talking about the capital gains. So if you invest in the capital gains in REC, in National Highway Authority of India or PFC bonds, right? Where within, and that is to be invested within the time period of 6 months. It's not like after the transfer you are just sitting for 1 year, then you're thinking like we should be doing some investment in the bonds. No, that's not the case. You have to do the investment within a period of 6 months. Then the amount invested in bonds up to rupees 50 lakh rupees per financial year, the benefit can be taken. That will be the maximum exemption will be allowed. And the lock-in period here is 5 years. The lock-in period is 5 years that the bonds cannot be transferred or pledged, and the investment must be made before tax filing due date. For section 54B, section 54B, it is applicable for the agricultural land, right? So the new agricultural land must be purchased. Like if you have to purchase agricultural land, you can be purchasing it within the next 2 years of the transfer. And like the LTCG amount is like reinvested into it, then you'll be getting the benefit. And the land is to be used for the agriculture purposes. That's the condition by the assessee or parents or spouse at least for 2 years. So within the period of transfer, within 2 years, you can be purchasing the agricultural land, and further the LTCG will be exempted in that scenario. And at least for 2 years, that land is to be used for the agriculture purposes and is not to be transferred. And further 54EE, that is for also for any of the long-term capital asset. So if you do invest the capital gains, again the capital gains only we are talking about. If you do invest the capital gains in units of notified funds, like in the startups, right? Within 6 months, if that investment is made, and up to rupees 50 lakh if the investment is made, then the lock-in period is 3 years, right? Lock-in period is 3 years, and if assets are transferred or pledged before 3 years, the exemption will be withdrawn in that scenario. So these are the different exemptions that can be taken on the capital gains, majorly for the LTCG only, right? Like for 54F, it's for the residential house property. It's for the residential house property. For the 54F, basically, it's for any of the long-term capital gain asset, but not for the residential house. 54EC is basically related to that you can be investing for 6 months. Sorry, within 6 months, you have to invest into the bonds. And for the lock-in period is 5 years in that scenario. And 54B is related to that you can be investing the amount into the agricultural land, but that should be like the agriculture is being done for at least 2 years. And 54EE is related to that you can be investing into the notified funds units, and the lock-in period in that scenario is 3 years. Okay, so that's the case. Further after that, it's about the CGAS. Important again. It's the CGAS. Like, if the reinvestment cannot be completed before the return filing due date, if the reinvestment cannot be done before the due date of the return filing, then you can be depositing the money in the CGAS account. So you can be opening the capital gain account under the CGAS scheme with the nationalized bank, and for the deposit amount still qualifies for the exemption, and money must be used within the prescribed period. So like, let's say you sold some property on 29th of the April, and the due filing date, let's say you sold the property on 29th of March, and further the due date is on 30th of April for interest, for the income tax filing. So you can be putting the amount, you can be depositing the amount in this CGAS, right? Let's say the time limit was 6 months, that in 6 months you can be investing the amount into the different areas. So you still be having the 6 months with you. Getting it? So that's a related idea related to the CGAS. That's a complete idea related to the CGAS. Clear so far? Do confirm so that we can proceed. Okay. Then it's ready to tax treatment of the gifts. Tax treatment of the gifts. Like if the gift is received by individual or HF, that is also becoming taxable. So it depends upon what type of gift you are receiving. So it depends upon what type of gift we are receiving, what is the value of the gift, and what is the relation of the donor, and what is the occasion of the gift. That depends upon it. So if you're receiving money gifts, cash, check, bank transfer, UPI, etc., right? So tax rule says what? That if the total money gifts from non-relatives during the year that exceeds 50,000 rupees. So money gifts, if they do exceed rupees 50,000 rupees, then those are taxable. Entire amount, not the excess amount, but the entire amount will become taxable, right? So if you receive 30,000, 25,000, no way. But let's say if you receive 30,000 in month January, and for the 25,000 rupees from the friends in February, now the total amount is 55,000. So since the total amount is exceeding 50,000, so you'll be taxed for the complete amount, not just the excess amount. Okay. Further, it's about if you receive the immovable property as a gift, like the land, property, building, flat, etc. Now, if the property received for free, if the property received for free, like if the stamp duty value we are talking about, right? SDV we say it to be, and you receive the property for free, and if that exceeds 50,000 rupees, that SDV, stamp duty value, exceeds rupees 50,000 rupees, then the entire SDV would be taxable. Entire SDV, even if you receive for free, that will become taxable. Okay. And the second scenario, it's related to what? The second scenario is like the property was bought at a lower price. Property was bought at a lower price. We purchase a property. Let's say uh, stamp duty value, or like the property was purchased for, let's say, 25,000 in year 1979, and now the stamp duty value is like, let's say, 4,50,000. Okay, now the SDV is exceeding the purchase value, right? So if the difference exceeds 50,000, now here the condition is, if the difference of the SDGs, case 2 we can say, if the particular SDV is exceeding the actual purchase price, actual purchase price, and further the difference exceeds, like the difference between this exceeds 50,000, right? Or 10% of consideration, or 10% of consideration, then also it will become taxable. Okay. Then after that, it's related to the specified movable property, like those are being gifted, shares, securities, jewelry, archaeological collections, drawings, paintings, sculptures, bullions. If those are basically gifted, so if that is without consideration and the fair market value exceeds 50,000, then it will become taxable. Then it will become taxable, like if it is without consideration. And for inadequate consideration, like if you have paid something for that, let's say you got the new shares which were worth rupees 2 lakh rupees, and someone gave it to you just for rupees 20,000, right? So that's not the case. So the difference between these two is more than 50,000, right? If it is more than 50,000, then also it will become taxable. Then at the actual purchase price, it will become taxable. Getting it? So now let's have a look at the gifts which are fully exempted. Which are fully exempted. Like gifts from the following relatives are fully tax free, irrespective of the amount. Like if you're receiving the gift from the spouse of the individual, brother or sister of the individual, brother or sister of the spouse of the individual, brother or sister of either parent of the individual, any lineal ascendant, descendant, or any lineal ascendant or descendant of the spouse, or spouse of any of the two persons. So in that scenario, like if you're receiving from spouse, brother, sister, parents, grandparents, children, grandchildren, then it is basically tax free, right? Getting it? So then it is tax free. And what are the occasion? Like gifts which are received on the occasion of marriage of the individual from any of the person, those are exempted. There is no limit. It can be from any of the persons. And if the gift is received through the will or by way of inheritance, that's fully exempted. If you basically receive the gift from the local authority, from any of the charitable trust, it's basically no tax upon that. So if you basically received a cash gift from the friend, rupees 60,000, let's assume you received a cash gift of 60,000 from a friend, would it be taxable? Yes, because it exceeded 50,000 rupees in amount that I told you about the cash gift. Because that was not related to a marriage function or something, na. That was a normal thing, normal occasion that you received 50,000 rupees. So that will be taxable. So basically, if you received a cash gift from the friend amounting 60,000, it is taxable. If you received the gold jewelry worth rupees, fair market value is basically 2 lakh rupees, right? From the maternal uncle, it is again taxable because uncle is not specified as a relative. Only brother, sister of parents qualifies for the same. Okay. If you're receiving the cash gift on wedding occasion, 5 lakh rupees, it's not taxable, right? If you're basically getting the listed shares, fair market value of rupees 3 lakh from the brother from for and further, that is not taxable. If you basically plot of land stamp duty value from friend, it is lesser than 50,000. It is not taxable. Getting it? And the total taxable gift income, cash from friend, like in this scenario, if we're looking at from this particular table only, from this example only, we are looking at the total taxable gift income that will be added to the other sources, that will be 2,60,000, because some things are not counted. Like this is not counted, the listed shares from brother not counted, right? And cash gift on wedding occasion is not counted. That's the case. Now there are some updates in 2025 budget. The first thing, it's about the rebate under the section 87A. Rebate under the section 87A. Like it says that earlier position was what? That no tax will be there if the income is like up to 7 lakh rupees. But the 2025 update says that no tax, like if you're having the salary up to, basically if your income is up to 12 lakh rupees, then no income tax upon you. And 75,000 of the standard deduction will be also be provided for the salaried class. So for salaried person, the amount will be 12 lakh and 75,000 rupees. And the new tax regimes are now like for 6 lakh to 9 lakh, it is 10%. For 9 to 12 lakh, it is previously it was 15%. But now it is what? Now it is 7 lakh to 10 lakh, 10%. And 10 lakh to 12 lakh, 15%. And that is effective from the financial year 25-26. Previously, it was 6 to 9, 9 to 12, but now 7 to 10, 10 to 12. Okay. And standard deduction is now 75,000. And LTCG, basically for LTCG, previously it was 10%, but now it is 12.5%. The exemption limit was raised. Like from 1 lakh rupees, it was raised to 1.25 lakh rupees. But the LTCG on equity is also increased from 10 to 12.5%. And if we look at the STCG, previously it was 15%, now it is 20%. Related to property LTCG, there was 20% with indexation, but now there are two options with indexation, without indexation. Without indexation, 12.5%. With indexation, 20%. TDS on rent, that's now 5%. Earlier, basically, it was 5%, but now it is 2%. Now it is 2%, right? And for the updated return filing, that was basically allowed, that was to be done within 2 years, but now it is extended up to 4 years. Then it is related to angel tax, like applicable on excess share premium, right? FMV and the issue price of the unlisted companies. It is abolished. Now it is abolished. The angel tax is now abolished. There is a surcharge cap also. There is a surcharge cap. Now the maximum surcharge previously was 37%, and now it is capped at 25%. We have already learned about it. And employer NPS contribution, like it was previously 10% for private sector employees, and now it is raised to 14%, equal to the central government employees. Now in the above table, it was not updated. Let me just revise to you, and that's why basically we have covered these updates. Now it is 14%, standing equal to that of the central government employees. Okay with it? So that will be all related to this particular chapter, and that was all about the chapter number 25. If you really like the video, make sure to rate this video out of 10, and do not forget to like this video and share this video among your friends and colleagues who are preparing for the JAIIB exam. And that will be all. Thank you so much, and see you again in the next video.